Now, last month's broad theme of October held goods for most risk assets, barring cryptos, and for safe haven assets like gold and the dollar. From geopolitics to trade risk, a U.S. shutdown and high valuations, traders had a lot to digest in October. Ultimately, what prevailed was confidence in corporate America and bets that rate cuts will keep momentum going for profits. Wall Street's bull market got fresh fuel at the end of a month that's lived up to its volatile reputation. In global markets, cryptos and crude were the biggest losers in October after surging to an all-time high of $125,500 in September. Bitcoin crashed to close out last month over 4%, lower to below $110,000. The crypto market has not recovered since October 10th flash crash that liquidated a record $20 billion, wiping out over 1.4 million traders. Benchmark Brent crude fell for the third straight month, down 2.2% for October. Sanctions on Russian oil giants had crude surge on trade flow worries for a few sessions, but bets of a supply glut weighed on prices. On the other hand, gold pulled back significantly from a record high of $4,380 an ounce. Still, the yellow metal is up for 50% for the year and ended last month with 3.6% gains to close above $4,000. The dollar wrapped up its second best month of the year as lack of official data muddied the outlook for the U.S. economy and the Federal Reserve's rate path. Turning to Asia-Pacific stock markets, Japanese Nikkei led the charge with multiple record highs on bets of pro-growth policies of new Prime Minister Sanae Takaichi. Nikkei marked the best month since 1990 on a robust domestic earnings. The other standout performer was India. Both Indian benchmarks surged to over a year high before pulling back, with all-time highs still in sight. Under pressure, Chinese stocks recovered after a one-year extension to the trade truce with the U.S.A Trump-Xi meeting at the APEC summit. In the Americas, the S&P 500 rose 2.3% in October for a sixth consecutive month of gains, marking the best run for the index since August 2021. The tech-heavy Nasdaq 7 straight months of positive returns to its longest since early 2018, buoyed by big tech, pristine balance sheets, and AI bullishness. The $17 trillion rally from April lows has pushed S&P 500 to almost 40% gains, marking the benchmark's biggest stretch of gains since 1950s. If history is any guide, November kicks off the best 6 months of the year for Wall Street, despite Trump's refusal to continue trade talks with Canada in response to Ontario's sponsored anti-tariff campaign. The stocks there showed modest gains. Brazilian stocks surged 2.3% after the country claimed of a favorable trade deal with the U.S. soon. European stocks wrapped up their fourth consecutive month of gains and the best since May. UK's FTSE gained the most in region, followed by French stocks. The German DAX managed to out a small gain. South Africa's benchmark reflected a positive trend in emerging market stocks, which have risen every month this year, a feat last seen in 1993. The MSCI Emerging Markets Index is up around 30% this year, outpacing most developed market benchmarks. Having looked at market move, let's now turn to the overall economic outlook, and we begin with Asia. India still remains a bright spot, with momentum indicators pointing to a healthy speed of growth. Personal income and GST tax rate cuts are already boosting consumer spending, with more positive numbers expected from a trade deal with the U.S. On the other hand, China's growth engine factory activity fell to the slowest pace in 6 months and marked the worst stretch in nearly a decade. Despite a U.S. truce, Beijing faces deflation risks, a recession in its real estate, and falling consumer demand. While the fourth plenum showed China's focus to overcome those issues, no concrete steps were detailed. Trump's trade rhetoric continues to weigh on the outlook for most of the other regional countries. In the Americas, the second longest government shutdown is now starting to really hurt economy activity. Public anger is rising with each passing day. Weakening business activity and a cooling job market pushed the Fed to cut rates again last month. However, the central bank toned down on further rate cuts and put the growth ball in the U.S. administration's court. The outlook for Canada, Brazil and Argentina is still negative because of Trump's brinksmanship. In Europe, Florence or Frankfurt, every place in the region is currently a good place for the European Central Bank. However, the numbers don't paint the same picture. Europe's growth engine, Germany, is still stuck in stagnation. France is not likely to meet its budget target, with politics compelling economic disasters. U.K. continues to struggle to fill a budget black hole. The size of most economies in the region are still below their pre-COVID levels. So European countries quickly need a clear, longer-term strategy and less wishful thinking with full pockets.